Despite a cool-off in energy prices, UGI Corporation has continued its 36-year dividend increase streak by raising its dividend to 37.5 cents per quarter. The year-long drop in propane and LPG costs have hit the company's bottom line, but what does that mean for its future dividend payments? In this video, I'm going to outline UGI's elegant business model, analyze their dividend and financial growth, and illustrate why the share price has dropped so much over the past year. Stick around till the end to see how much you can earn investing in UGI at today's discounted prices. Due to their strong dividend growth, steady increases in financial metrics, and stable payout ratios, UGI is a good choice for long-term dividend investors looking to secure a reliable passive income stream for retirement. Before we even start to look at UGI's financials, we must understand how the company makes money. You might know that UGI is in the utilities sector, but how exactly does the business generate its revenue? One of UGI's key revenue streams lies in the distribution and marketing of propane, an essential energy source for homes and businesses. Their extensive network ensures that customers receive reliable and efficient propane delivery, enabling them to power their appliances, heat their spaces, and carry out their daily activities with ease. In addition to propane, UGI Corporation has a robust presence in the natural gas distribution industry. Through their network of pipelines, they deliver natural gas to communities, ensuring a stable supply to meet the energy demands of households, schools, and commercial establishments. Expanding their reach beyond national borders, UGI also operates an international liquefied petroleum gas or LPG distribution network. This global endeavor allows UGI to cater to diverse customers across Europe, providing them with the convenience and benefits of LPG energy. To further bolster their revenue streams, UGI Corporation engages in energy marketing and trading. Leveraging their industry experience and market insights, they participate in the buying and selling of energy commodities, maximizing opportunities in the dynamic energy marketplace. UGI Corporation is also committed to exploring sustainable energy solutions. With a focus on renewable energy, they invest in clean technologies that align with their vision of a more sustainable future. This dedication to environmental responsibility serves as an integral part of their business strategy. As UGI continues to grow, adapt, and innovate, their versatile business model enables them to thrive in a rapidly changing landscape. By combining their expertise, diverse revenue streams, and commitment to sustainability, UGI Corporation remains a respected and influential player in the utilities sector. With a clear understanding of how UGI serves its communities and generates its revenue, we can now take a deeper dive into the history of their dividend, financial growth, and the sustainability of their dividend distributions. For weekly in-depth videos analyzing the best dividend-paying companies on the market, subscribe to the channel and turn on notifications. If you're enjoying this content, make sure to like the video and leave a comment to let me know your thoughts on UGI and the energy sector as a whole. First, we'll look at the key metrics of UGI's dividend distributions, namely their current yield, dividend growth, and dividend increase streak. The dividend yield is calculated as the total annual dividend divided by the current share price, and represents the returns an investor can expect in dividends. UGI's current yield is 5.67%, which is higher than their 5-year average yield of about 3.5%. This increase in yield comes as a result of a 1-year slide in share price, which we'll discuss in a later section of this analysis. The dividend growth is calculated by measuring the compounded growth rate of the dividend amount in US dollars over many time periods and illustrates the income growth an investor can expect while holding a stock. Ideally, we want to see historical dividend growth between 8 and 12%, but at a minimum this growth should be greater than 4% over a 10-year time period. UGI's 10-year dividend growth rate is 7.27% and their 3-year dividend growth rate is 10.22%, indicating they're growing their dividend at an increasing rate. The dividend increase streak represents the number of consecutive years a company has raised its dividend and depicts the company's commitment to shareholder distributions and income growth. I don't invest in companies that have an increase streak shorter than 10 years. The longer the streak, the better. UGI has been paying dividends since 1972 and has raised their dividend every year for the past 36 years. This is an impressive streak, and it's important to note that UGI didn't cut their dividend 36 years ago, but merely started their perpetual increase streak. Prior to 1987, the company paid consistent dividends, but raised them only sporadically. Next, we'll look at the sustainability of the dividend by analyzing their payout ratios. A payout ratio is calculated by dividing the total dividend distribution by some income metric over a given time period, typically on an annual basis. Most payout ratios are measured strictly on net income, but I like to calculate it also on operating cash flow and free cash flow, since these metrics are a better representation of real cash coming into the business. Low payout ratios indicate a safe dividend since the company is paying out less than they're earning, while a payout ratio above 100% could mean a business needs to cut its dividends soon to continue normal operations. I generally consider payout ratios below 75% to be safe, as this allows for market downturns and drops in income without jeopardizing the dividend. UGI's payout ratios on net income, operating cash flow, and free cash flow all remained below 61% over the past 3 years, though they did post negative free cash flow in 2022. As you can see, payout ratios in 2018 and 2019 are a little higher. But the past 3 years indicate to me UGI has improved their financial metrics enough to ensure a sustainable dividend. Lastly, we'll look at the financial growth of UGI by analyzing their annual and quarterly income statements, balance sheets, and statements of cash flow. Specifically, we'll look at the 10-year trendline growth of net income, operating cash flow, and free cash flow. Growth in these metrics illustrates the overall health of the business and shows an investor how successful management has been at growing the company. In general, growth in these metrics above historical inflation of 2 to 3% indicates a healthy business and ensures the long-term viability of the company. It's important to note that financial growth is not weighted as heavily in dividend analysis as the previous metrics, but should still be considered when analyzing a stock. UGI has had relatively weak financial growth over the past 10 years, with operating cash flow and operating income only increasing at about 0.5% per year. Free cash flow has actually been declining at almost 8% per year. That being said, net income growth has been trending up at almost 3.25% over the past 10 years. Over the past 5 years, net income and operating income have been trending up at over 20%, mostly due to the spike in propane and LPG from mid-2020 to mid-2022. Since these prices have cooled down, we can expect income levels to drop as well, but the safe payout ratios should insulate the dividend and protect investors from a dividend cut. So how much can we actually earn investing in UGI? Let's take the values we just discussed over to MarketBeat's dividend calculator and see what we get. If we invest $1,000 in UGI today with a 5.67% yield, a 7.27% dividend growth rate, and a 1% annual share price appreciation, our yield on cost will be 118% with an average annual return of 10.43%. The yield on cost is calculated by dividing the annual dividend by the total investment over a given time period, and the average annual return represents the combination of share price appreciation and dividend distributions over the same time frame. Even though the initial yield is less than 6%, dividend reinvestment steadily increases your yield on cost and average annual return over time. Over 20 years, almost $6,500 worth of dividends would have been paid, and we would earn $1,477 on the 20th year. Since energy prices have dropped, investors have been fleeing from UGI over the past year, causing the share price to drop to a near 10-year low of $26.45. The price action over the past 2 years has been consistent with the fluctuations in energy prices, but given the key dividend metrics analyzed in this video, I'm confident in the company's ability to continue to raise its dividend for the foreseeable future. UGI is an old company with a long track record of safe dividend distributions, which doesn't appear to be changing as energy prices drop. If you enjoyed this video, give us a like and subscribe to the channel. As always, stay safe and take it easy.